The world of money is changing fast. Digital currencies like Bitcoin and Ethereum are reshaping how we think about and use money. This isn't just a trend. It's a fundamental shift in finance. More people and businesses are adopting digital assets for payments, investments, and efficiency. Digital currencies promise faster, cheaper transactions and greater financial inclusion. Anyone with internet access can participate, challenging the old banking system. Understanding this evolution is now essential for everyone. The concepts may seem complex, but the core idea is simple. Money is becoming digital, decentralized, and global. This guide will help you grasp the basics and navigate the new financial frontier. Welcome to the future of money. Digital currencies are changing daily life for everyone, not just techies or investors. They offer new ways to pay, send money abroad, and save for the future. For the unbanked, digital assets provide access to financial services once out of reach. For others, they offer more control and less reliance on banks. But with opportunity comes risk. Security threats and shifting regulations are real concerns. Staying informed is key to making safe, smart choices. In this guide, we'll break down what you need to know to protect yourself and your money. We'll cover security, regulations, and the technology behind digital currencies. By the end, you'll be ready to navigate the future of finance with confidence. Is your digital money safe? Security is a top concern in the crypto world. Digital currencies are innovative, but they're also targets for hackers and scammers. Unlike banks, there's no one to call if your funds are stolen. Think of your digital wallet as your own personal bank vault. Only you hold the keys. Protecting your assets means using strong security practices, unique passwords, secure devices, and constant vigilance. Learn about threats like hacking, phishing, and malware. In this world, you're in control and responsible for your own security. Stay informed, stay cautious, and take security seriously. With the right habits, you can keep your digital wealth safe. Security isn't optional, it's essential. Digital wallets are where you store your cryptocurrencies. Hot wallets online are convenient for daily use, but more vulnerable to attacks. Cold wallets, offline like hardware devices, are safer for storing larger amounts. Your private key is the master password to your funds. Never share it, never lose it. Lose your key, lose your money. There's no recovery. Most wallets provide a recovery phrase. Write it down and store it securely offline. Don't keep sensitive info on your phone or computer. Treat your keys and recovery phrase like gold. The safety of your digital assets depends on how well you protect your wallet. Secure storage is the foundation of digital wealth. Scammers are everywhere in the crypto world. Stay alert. Phishing emails and fake websites are common tricks to steal your info. Always double-check website URLs and never click suspicious links. Enable multi-factor authentication, MFA, for extra protection. Keep your devices and apps updated with the latest security patches. Use strong, unique passwords and consider a password manager. Beware of too good to be true offers. Free crypto is almost always a scam. Ignore celebrity endorsements and social media giveaways. Good digital hygiene and skepticism are your best defenses. Outsmart scammers by staying informed and cautious. The legal landscape for digital currencies is complex and ever-changing. Some countries embrace crypto, others ban it, and many are still figuring it out. This patchwork of rules creates uncertainty for users and businesses. Regulations range from open innovation to strict bans and heavy compliance requirements. Anti-money laundering, AML, and Know Your Customer, KYC rules are common in many places. What's legal in one country may be illegal in another. For businesses, navigating global regulations is a major challenge. For users, the rules can change depending on where you live or travel. Staying updated on local laws is crucial for safe participation. The future of digital money depends on how these rules evolve. For businesses, the rise of digital currencies presents a tantalizing yet difficult dilemma. On one hand, the opportunities are incredibly exciting and honestly pretty hard to ignore. Accepting digital currencies can open up a new global customer base. It allows companies to connect with a younger, tech-savvy demographic that is eager to use these new forms of money. Furthermore, digital currency transactions can offer significant advantages over traditional payment systems. They can be faster and cheaper, especially for cross-border payments, which are often slow and burdened with high fees when processed through the conventional banking system. This can improve efficiency and boost a company's bottom line. On the other hand, the risks and uncertainties are substantial, making many business leaders hesitant to dive in. The regulatory ambiguity we have discussed is a primary concern. A company could invest heavily in integrating cryptocurrency payments only for new regulations to make their operations non-compliant or even illegal overnight. This legal instability makes long-term planning incredibly difficult. Beyond the regulatory hurdles, the price volatility of many digital currencies is another major risk factor. A payment received in Bitcoin could be worth significantly less by the time the business converts it into their local currency, potentially wiping out their profit margin on a sale. This forces businesses into a delicate balancing act. They have to carefully weigh the potential rewards against the very real risks. Some pioneering companies have fully embraced digital currencies, viewing the potential upside as worth the challenge. They see themselves as leaders on a new frontier and are willing to navigate the complexities to gain a first-mover advantage. Other, more conservative businesses are taking a wait-and-see approach. They are closely monitoring the market and the regulatory developments, waiting for more clarity and stability before they commit any significant resources. The fear of being left behind is palpable, but so is the fear of making a costly mistake. Ultimately, the decision for a business to engage with digital currencies depends on its specific industry, customer base, and risk tolerance. A technology startup might be more willing and able to adapt to the changing landscape than a large, established corporation with complex internal processes. Many companies are starting with small, cautious steps. They might begin by accepting payments in more stable digital currencies, known as stablecoins, which are pegged to traditional currencies like the US dollar. This allows them to explore the benefits of digital payments while mitigating the risk of price volatility, providing a safer entry point into this new financial world. Governments and central banks, find themselves walking a pretty precarious tightrope these days. They're tasked with a dual mandate that, honestly, can be pretty contradictory when it comes to digital currencies. On one side, they have a responsibility to foster economic innovation and competitiveness. Stifling a potentially revolutionary technology could mean their country falls behind in the future global economy. They see the potential for blockchain technology to streamline financial services, create jobs, and attract investment. Ignoring this potential is a risk in itself, as capital and talent may flow to more forward-thinking jurisdictions that have created a welcoming environment for the digital asset industry. But, on the other side of the tightrope, governments also have a fundamental duty to protect their citizens and maintain financial stability. The decentralized and often anonymous nature of some digital currencies makes them attractive for illicit activities, a fact that regulators just can't ignore. They are deeply concerned about consumer protection, wanting to shield everyday investors from rampant speculation, fraud, and market manipulation. Furthermore, the rise of private global currencies poses a direct challenge to a nation's monetary sovereignty. It can weaken a central bank's ability to control the money supply, set interest rates, and manage the national economy effectively during times of crisis. This balancing act is why we see such a wide variety of regulatory responses. The approach a government takes often reflects its specific national priorities. For example, a country with a strong technology sector might lean towards promoting innovation, creating regulatory sandboxes where new financial products can be tested in a controlled environment. Conversely, a country with a history of financial instability or capital flight might impose strict controls to prevent digital currencies from undermining its local currency and economic policies. There's really no one-size-fits-all solution, and each government is trying to find the right equilibrium for its unique circumstances. This ongoing struggle for balance means that the regulatory landscape will likely remain in flux for the foreseeable future. As the technology evolves and its adoption grows, governments will continue to adapt their rules. We're also seeing a rise in international cooperation as bodies like the Financial Action Task Force, or FATF, work to establish global standards for AML and KYC compliance in the crypto space. For anyone involved in digital currencies, staying informed about these regulatory shifts is not just advisable. It is a necessity for navigating the path forward. The decisions made by regulators today will shape the future of money for decades to come. When people talk about digital currencies, the first name that usually comes to mind is Bitcoin. Created in 2009 by an anonymous person or group known as Satoshi Nakamoto, Bitcoin was the very first cryptocurrency. It introduced the world to a radical new idea, a form of money that could be sent directly from one person to another without needing a bank or any other financial institution in the middle. This peer-to-peer electronic cash system was revolutionary. It laid the foundation for the thousands of other digital currencies that have since been created. Bitcoin remains the largest and most well-known cryptocurrency by a significant margin, often serving as the gateway for newcomers into this space. Bitcoin's primary purpose is to function as a secure and decentralized store of value and a medium of exchange. Many people compare it to digital gold. Like gold, there is a limited and finite supply of Bitcoin. Only 21 million Bitcoins will ever be created, a rule that is permanently encoded into its software. This scarcity is a key feature that gives it value. It cannot be devalued by a government printing more of it, which makes it an attractive asset for people looking to protect their wealth from inflation. This characteristic has made it a popular choice for long-term investment, with many holders treating it as a digital savings technology rather than something they use for daily purchases. The network is powered by a global community of participants known as miners. These miners use powerful computers to solve complex mathematical puzzles. By solving these puzzles, they validate and add new transactions to Bitcoin's public ledger, which is called the blockchain. In return for their work and the energy they expend, miners are rewarded with newly created Bitcoin. This process is called proof of work, and it's what secures the network, making it incredibly difficult and expensive to alter or cheat. This decentralized security model ensures that no single person, company, or government can control Bitcoin or censor transactions on its network. However, Bitcoin is not without its limitations. Its design, while very secure, can be slow. The network can only process a small number of transactions per second, which can lead to delays and higher fees during times of high demand. This makes it less ideal for small everyday purchases like buying a cup of coffee. Furthermore, the mining process consumes a significant amount of electricity, raising environmental concerns that the community is actively working to address. Despite these challenges, Bitcoin's role as the original, most secure, and most decentralized digital currency has solidified its position as a cornerstone of the entire digital asset ecosystem. While Bitcoin introduced the world to decentralized money, another digital currency called Ethereum took the underlying technology and imagined a much broader purpose for it. Launched in 2015, Ethereum is not just a digital currency. It is a global open source platform for decentralized applications. Its creator, Vitalik Buterin, envisioned a worldwide computer that anyone could use to build and run unstoppable programs. The cryptocurrency of the Ethereum network is called Ether, or ETH. Ether is used to pay for computational services and transaction fees on the network, acting as the fuel that powers this global computer. This makes Ethereum fundamentally different from Bitcoin's more singular focus on being money. The key innovation that Ethereum introduced is the concept of smart contracts. A smart contract is a self-executing contract with the terms of the agreement written directly into lines of code. Think of it like a digital vending machine. You put in the required amount of ETH, and the contract automatically delivers the product or service you requested without needing any human intermediary. This powerful feature allows developers to build complex applications that are far more sophisticated than simple monetary transactions. These applications are often called dApps, which stands for decentralized applications because they run on the Ethereum network rather than on a single centralized server. This programmability has given rise to an entire ecosystem of innovation built on top of Ethereum. One of the most significant areas is decentralized finance, or DeFi. DeFi aims to rebuild traditional financial services, like lending, borrowing, insurance, and trading, using smart contracts. This creates a financial system that is open, transparent, and accessible to anyone with an internet connection, without relying on traditional banks. Another popular use case is non-fungible tokens, or NFTs. These are unique digital tokens that can represent ownership of a piece of digital art, a collectible, or even a real-world asset, all secured and verifiable on the Ethereum blockchain. Like Bitcoin, Ethereum has also faced challenges, particularly with scalability. As the platform's popularity has soared, its network has become congested, leading to high transaction fees, known as gas fees. To address this, the Ethereum community has been working on a series of major upgrades, most notably a shift from the energy-intensive proof-of-work system to a more efficient proof-of-stake model. This transition, along with other scalability solutions, aims to make the network faster, cheaper, and more sustainable. Ethereum's vision of a programmable blockchain has made it the leading platform for developers and a central hub for innovation in the digital asset space. Section 3. The engine of it all. How blockchain works. At the heart of Bitcoin, Ethereum, and most other digital currencies is a groundbreaking technology called blockchain. To understand digital currencies, you must first grasp the basic concept of what a blockchain is and why it is so important. In simple terms, a blockchain is a type of digital ledger or database. What makes it unique is how it is structured and maintained. Information is gathered into groups known as blocks, which hold sets of transactions. Each new block is then cryptographically linked to the previous one, forming a chronological chain. This structure makes the data incredibly secure and resistant to change. The most revolutionary aspect of blockchain technology is its decentralized nature. In a traditional database, all the information is stored in a central location, controlled by a single entity like a bank or a tech company. This creates a single point of failure and control. A blockchain, however, is distributed across a vast network of computers all around the world. Every participant in the network holds a copy of the entire ledger. When a new transaction occurs, it is broadcast to the network, and all participants must agree on its validity before it can be added to the chain. This distributed consensus makes the system incredibly resilient and transparent. This structure ensures that the data on a blockchain is immutable, meaning it cannot be altered or deleted once it has been recorded. To change the information in a past block, a malicious actor would have to not only alter that block, but also every single block that came after it across the majority of the network's computers simultaneously. This would require an immense amount of computing power, making it practically impossible on a large, secure network like Bitcoin's or Ethereum's. This immutability is what creates trust in the system. It guarantees that the transaction history is permanent and verifiable by anyone without needing to trust a central authority. However, blockchain technology is not a magic solution for every problem. As we have seen with Bitcoin and Ethereum, early versions of this technology have faced significant challenges, particularly with scalability and energy consumption. Processing transactions across a decentralized network is inherently slower and less efficient than using a centralized database. Researchers and developers around the world are actively working on innovative solutions to overcome these limitations. The core principles of decentralization, transparency, and immutability give blockchain the potential to revolutionize not just finance, but many other industries, from supply chain management to voting systems. Section 1. Beyond speculation, digital currencies in action. While much of the public conversation around digital currencies focuses on price speculation and investment, their real-world applications are quietly starting to make a tangible impact. These technologies are moving beyond the trading charts and into the hands of ordinary people and businesses. We are beginning to see practical uses that solve real problems. One of the most powerful examples is in the area of financial inclusion. Billions of people around the world do not have access to a bank account. This prevents them from saving securely, receiving payments easily, or getting loans. Digital currencies are changing this by offering a viable alternative to the traditional financial system. For these unbanked populations, a simple smartphone can become a gateway to the global economy. With an internet connection and a digital wallet app, a person can receive money, store it securely, and send it to others. This is empowering millions of people who have been left behind by conventional banking. Consider a small farmer in a rural village. They can now receive payment for their crops directly to their digital wallet without needing a bank account or traveling long distances to a city. This direct access to financial tools can help them build savings, invest in their business, and improve their quality of life in a profound way. Another major real-world impact is in the world of cross-border payments and remittances. Every year, migrant workers send hundreds of billions of dollars back home to their families. Traditionally, this process is slow, expensive, and complicated. Legacy money transfer services often charge high fees, and it can take several days for the money to arrive. Digital currencies can make these transactions almost instantaneous and dramatically cheaper. By cutting out the multiple intermediaries involved in the traditional system, more of the hard-earned money reaches the families who depend on it, providing a vital economic lifeline for many developing countries. These practical applications demonstrate the transformative potential of digital currencies. They are more than just a new asset class for investors. They are tools that can promote economic freedom and efficiency. From helping a freelance designer in one country get paid instantly by a client in another, to enabling humanitarian organizations to deliver aid more directly and transparently to people in crisis zones, the use cases are growing every day. These everyday impacts show that the digital currency revolution is not just about technology, it is about creating a more accessible and equitable financial system for everyone, everywhere. Section 2. The El Salvador Experiment, a nation's Bitcoin bet. Perhaps the boldest real-world application of a digital currency to date happened in September 2021. The nation of El Salvador took an unprecedented step and became the first country in the world to adopt Bitcoin as legal tender, alongside the US dollar. This was not a small-scale pilot program. It was a nationwide policy. The government launched a national digital wallet called the Chivo Wallet and offered every adult citizen a starting bonus of $30 in Bitcoin to encourage adoption. This move instantly placed digital currency at the center of a national economy, turning the entire country into a real-time case study for the rest of the world to watch. The motivations behind this decision were multifaceted. A primary goal was to boost financial inclusion. A large portion of El Salvador's population, around 70%, did not have a bank account. The government hoped that by making Bitcoin accessible, it could bring these citizens into the formal financial system. Another major driver was remittances. Money sent home by Salvadorans working abroad makes up a huge part of the country's economy, over 20% of its GDP. By enabling remittances through Bitcoin, the government aimed to save citizens millions of dollars each year in transaction fees charged by traditional money transfer companies, putting more money directly into family pockets. The experiment, however, has been met with a mixture of enthusiasm and serious criticism. Supporters point to the potential benefits of attracting foreign investment, boosting tourism from the global Bitcoin community, and giving citizens a way to protect themselves from inflation. They see it as a forward-thinking move that positions El Salvador as a leader in technological innovation. On the other hand, critics raise significant concerns. They highlight the extreme price volatility of Bitcoin, which could destabilize the savings of ordinary people who are unfamiliar with such risks. International financial bodies like the IMF have also warned of the potential for financial instability and money laundering. The world is watching El Salvador's Bitcoin journey with intense interest. The results so far have been mixed, with challenges in technical implementation and public education. The long-term success or failure of this bold experiment is still uncertain. Regardless of the outcome, El Salvador's decision has been a landmark moment. It has moved the conversation about digital currencies from a theoretical debate into a practical reality on a national scale. It forces other governments and financial institutions to seriously consider their own strategies, and has undeniably accelerated the global discussion about the role of digital currencies in the future of national economies. The involvement of major corporations is another clear sign that digital currencies are moving from the fringes into the mainstream economy. For a long time, most large companies viewed cryptocurrencies with skepticism, seeing them as just too volatile and unregulated. However, that attitude has shifted dramatically in recent years. We are now seeing some of the biggest and most respected names in business begin to engage with digital assets. This corporate embrace adds a powerful layer of legitimacy to the space. When a well-known company starts to accept cryptocurrency for payments or holds it on its balance sheet, it sends a strong signal to the market that this technology is here to stay. This corporate adoption is happening in several different ways. Some major companies in sectors ranging from technology to retail have started to accept digital currencies as a form of payment for their goods and services. This gives customers more choice and can attract a new segment of buyers who prefer to use their digital assets. Other companies, like the business intelligence firm MicroStrategy and the electric car maker Tesla, have taken a different approach. They have invested billions of dollars of their corporate treasury funds into Bitcoin, treating it as a reserve asset to hedge against inflation and the potential devaluation of traditional currencies. The entry of traditional financial giants is also a critical development. Companies like PayPal and Visa, which form the backbone of the current global payment system, are now integrating cryptocurrency services. They are allowing their millions of users to buy, sell, and hold certain digital currencies directly through their platforms. They are also developing ways for crypto payments to be seamlessly converted and used at any merchant that accepts their network. This integration bridges the gap between the old financial world and the new, making it much easier for the average person to access and use digital assets in their everyday lives without needing specialized knowledge. This growing corporate involvement creates a powerful feedback loop. As more large companies participate, it increases the liquidity and stability of the market. It also encourages more regulatory clarity, as these established players have the influence to engage with policymakers and help shape sensible rules. This, in turn, makes even more businesses feel comfortable entering the space. The corporate embrace is a crucial step toward widespread adoption. It signifies that digital currencies are becoming an integrated part of the global economic fabric, impacting everything from how we shop to how major corporations manage their finances. The rise of digital currencies is sending profound ripple effects across our global economic and social landscapes. This impact extends far beyond the financial markets, beginning to reshape fundamental structures we have long taken for granted. One of the most significant effects is the disruption of the traditional financial industry. For centuries, banks and other financial institutions have acted as trusted intermediaries, controlling the flow of money, credit, and investments. Decentralized finance, Kesanat finance, or DeFi, built on blockchain technology, challenges this entire model. It offers alternative systems for lending, borrowing, and earning interest that are open, permissionless, and often more efficient, putting pressure on traditional players to innovate or risk becoming obsolete. This disruption creates both new opportunities and significant challenges. On one hand, it can lead to a more competitive and consumer-friendly financial sector. By reducing the need for intermediaries, DeFi can lower costs, increase transparency, and give individuals more control over their own assets. This could democratize access to sophisticated financial tools that were once reserved for wealthy clients and large institutions. On the other hand, this shift also introduces new risks. The DeFi space is still largely unregulated and has been a target for hacks and exploits. The transition away from established regulated institutions towards a new code-based system requires a major shift in how we think about risk management and consumer protection. Furthermore, the emergence of digital assets is forcing a re-evaluation of monetary policy and economic governance. Central banks traditionally manage their national economies by controlling the money supply and setting interest rates. The growing adoption of decentralized currencies like Bitcoin, which operate outside the control of any central authority, can potentially weaken these tools. If a significant portion of an economy begins to operate using a currency that the government cannot influence, it becomes much harder to steer the economy during periods of recession or inflation. This pushes central banks to explore their own innovations, such as central bank digital currencies. in an attempt to retain relevance in a digital future. This evolving landscape is also fostering the creation of entirely new economic models. The concept of tokenization, for instance, allows for real-world assets like real estate, art, or even a company's future revenue to be represented as digital tokens on a blockchain. These tokens can be easily divided and traded, opening up investment opportunities to a much broader audience. This could lead to more liquid markets and a more equitable distribution of wealth. It also enables new forms of community-owned and governed organizations, known as decentralized autonomous organizations, which could change how businesses and projects are funded and managed, creating a more collaborative and distributed economic future. The social implications of the digital currency revolution are just as profound as the economic ones. At its core, this technology touches upon fundamental concepts of ownership, privacy, and personal freedom. The idea of financial sovereignty, the absolute control over one's own money without reliance on a third party, is a powerful driver for many people drawn to this space. In many parts of the world, citizens live under unstable political regimes or face the risk of having their bank accounts frozen or their assets seized. For these individuals, digital currencies can offer a lifeline, providing a way to secure their wealth and transact freely in a censorship-resistant manner, independent of local, political, or economic turmoil. This newfound sovereignty, however, comes with a significant trade-off in responsibility. As we have discussed, being your own bank means there is no customer service to call if you lose your private keys or fall victim to a scam. This places a heavy burden of education and diligence on the individual user. It creates a new digital divide, not just between those with and without internet access, but between those who have the technical knowledge to navigate this complex world safely and those who do not. The potential for catastrophic financial loss due to simple mistakes is a major social hurdle. Bridging this knowledge gap is essential for ensuring that the benefits of this technology are accessible to all, not just a select few. The transparent nature of public blockchains also raises complex questions about privacy. While transactions can be pseudonymous, they are recorded on a public ledger for anyone to see. Every transaction is traceable, creating a permanent, unchangeable record of financial activity. While this transparency is excellent for auditing and preventing fraud, it can be at odds with the expectation of financial privacy that people are accustomed to with cash. This has led to a debate within the community and among policymakers about the right balance between transparency and privacy, spurring the development of new privacy-enhancing technologies and raising important questions about the future of financial surveillance in a digital age. Finally, the rise of digital currencies is fostering the growth of new global online communities. These communities are not bound by geography, but by a shared interest in a particular technology or project. They collaborate on development, governance, and education, forming a kind of digital civil society. These networks can empower individuals and facilitate collective action in ways that were previously impossible. However, they can also become echo chambers, susceptible to hype and misinformation. The social fabric is being rewoven in digital form, creating new forms of social organization that are both powerful and unpredictable, and whose long-term impact on society we are only just beginning to understand. We stand at a pivotal moment in the history of money. The world of digital currencies is no longer a niche interest for tech enthusiasts. It is a powerful force that is actively reshaping our global financial system. Throughout this journey, we have explored the immense potential and the significant challenges that define this new frontier. From the critical importance of security and the complex maze of regulations to the groundbreaking technology of blockchain and its real-world applications, it is clear that this is a revolution with deep and lasting implications. The path forward is dynamic and uncertain, but one thing is clear. Staying informed is no longer optional. It is essential for navigating the future. The key to successfully engaging with this new world is a commitment to continuous education. The technology, the market trends, and the legal landscape are all evolving at an incredible speed. What is true today might be different tomorrow. It's crucial to seek out reliable and reputable sources of information, to be wary of hype, and to approach the space with a healthy dose of curiosity and skepticism. Understanding your own financial goals and your tolerance for risk is equally important. Digital currencies are known for their price volatility, and you should never invest more than you are willing and able to lose. Base your decisions on careful research, not on emotion or the fear of missing out. As we look ahead, the conversation about digital money will only grow louder. The experiments of today, like El Salvador's Bitcoin law and the corporate adoption by major companies, are just the beginning. The development of central bank digital currencies will add another layer of complexity, creating a future where various forms of digital money, decentralized, corporate, and state-issued, coexist. Preparing for this future means being adaptable and open-minded. It means understanding that the very concept of money is being redefined, bringing with it new opportunities for financial inclusion and economic innovation, as well as new responsibilities for every participant. Ultimately, the future of money is not something that will simply happen to us. It is something we will all help to shape. By educating ourselves, participating in the conversation, and making thoughtful decisions, we can influence the direction of this transformation. Whether you are an individual investor, a business owner, or simply a citizen of the world, understanding this shift is empowering. It allows you to protect your assets, seize new opportunities, and confidently navigate the economic landscape of the 21st century. The journey into the world of digital currencies is just getting started, and being prepared is the best way to ensure you are ready for what comes next.